let's bring Fernando on. He's patiently waiting there in the background. Good to see you, buddy.
Yeah, likewise. How you guys doing?
Good.
So, are you still hunkered down in the basement?
Not in the basement. I'm in the office upstairs today.
I do feel sorry for you living in Chicago right now, because we were just ranting about our Democratic governors and how they seem to be holding those states hostage right now. And, the rest of the area is opened up. Now, we have a benefit here because we're right on the North Carolina, South Carolina line, and our business is in South Carolina. I live in North Carolina. I've been complaining that my gym can't open in North Carolina because it's not safe, although they're allowing tattoo parlors and hairdressers and nail salons to be open. But, you get touched so much by other people in the gym.
Not the gyms I go to.
But fortunately for me, I also have a branch of that same gym here in South Carolina. So I'm cheating. On my way home from work, I stopped in the South Carolina one.
Well, let's introduce Fernando to everybody. Fernando Angelucci is with Titan Wealth Group.
Yep.
And you specialize in, wholesaling, arbitrage, Airbnb, and storage units. Is there anything else? Anything you don't do?
Yeah. So self-storage is the main one. We do have a small wholesale business in Chicago, and we actually shut down the Airbnb business after this whole COVID thing. So.
Okay.
Well, so were you having an issue with cancellations on the Airbnb thing?
Yeah, and we didn't like the way that the company itself, Airbnb, was treating the host, so we just decided to just cut ties.
Right. Now, were those homes in the Chicago market?
Yep, right downtown.
Yeah, that's tough. And like everything else, real estate is local on the single family side of things. But I know I'm going to get you to tell us your story here first, but I do understand that you're buying self-storage all over the country, right?
Yeah, that's correct.
But mainly in the Midwest?
So right now, the majority of our portfolio is in the Midwest, but we do have properties kind of all over the place. Just bought one in your neck of the woods in Franklin, North Carolina. So not too far from you, a little bit of a hike still. We primarily specialize in the Midwest just because there's so much more value in the Midwest. And then outside of the Midwest, we'll only stay to the very low tax states.
Did you actually do feet on the ground in Franklin?
Yeah.
That's a neat little place, isn't it?
It's awesome. Great trout fishing, awesome streams. It's a beautiful place.
Big equestrian community there as well. So they got some beautiful horse farms up there too.
Yeah, exactly.
Yeah, it's awesome. All right. So I know when you were very young, you read Rich Man, Poor Dad.
Rich Man, Poor Dad.
Yeah. Rich Dad, Poor Dad.
There you go.
Okay. Sorry. See, I've been hunkered down in my basement a while too.
I can't let him get away with too many things.
So that kind of got you interested in investing, and then you went to college. And while you were in college, you did a little investing, or did you wait till after you got out?
Yeah, in college, I primarily was just reading books and going to seminars and RIA groups. I didn't start investing until I got out of college.
Okay. So when you graduated, were you an engineer?
Yeah.
Is your background, and you were with Dow Chemical, right?
Yeah. I usually say Fortune 50 company, but yeah.
Oh, sorry.
That's okay.
Didn't want to name names, but that's a pretty big name.
Right.
Yeah. All right. Well, yeah. So what? Why did you decide? Am I breaking a rule there? I'm sorry.
No, it's okay.
Well, at least he didn't say it. You can say things.
So, what made you decide to make the switch over into being a full-time investor once you started?
Yeah, my biggest thing was, the hours I was putting in at that Fortune 50 company. I was working from 5 a.m. to about 9 p.m. each day, and I was on a fixed salary. So the extra hours I put in, I wasn't getting compensated for. I was making good money. I think I was making $50,000 or $60,000 a year, right out of college. But I noticed that the amount of time I was spending was really, I mean, there wasn't in return the more time I spent. And I found that working in the 9-to-5 life, there was a lot of red tape and not a lot of ability to create wealth quickly.
Mm-hmm.
So that's when I started investing in single family homes to begin with, first as a wholesale investor. And then I started flipping those single family homes and then eventually holding them for rentals. And then from there, I moved up into multifamily and started doing the same thing, both flips and rentals as well. Now, you kind of alluded to the fact when you live in a state that is very tenant friendly, let's say, it makes it very difficult to be an investor. And not a lot of investors like to invest outside of their market to begin with. So as I was cutting my teeth, I was just investing in my markets. And we were having a lot of issues with not only evictions, but just the time it takes to go through that process in the states that we're in. I had an eviction that lasted 8 months, and that
Wow.
outside of the 8 months, there was also $25,000 in damage just on that one apartment unit.
What state was that in?
That was in Chicago, Illinois.
Okay. Yeah.
Yep. And it was, I mean, that knocked out profitability on that building for like 3-4 years, right? So we just decided after a while, this doesn't make sense. We need something that, truly is more of a passive investment where the laws are stacked in our favor as opposed to being stacked against us. And that's when we found self-storage.
Mm-hmm.
Well, you don't have anyone calling you in the middle of the night saying my toilet clogged.
No toilets.
What do you mean I can't put cotton towels down the toilet?
Right.
Oh man, yeah.
Is that frowned on?
Yeah.
So, what kind of properties are you looking for, and how do you determine the type of self-storage properties you want to go after?
Yeah. So before I even get into that, I'll kind of talk a little bit more about why we ended up going into self-storage.
Oh, sure.
Number one, I mentioned that as opposed to having to go through evictions, we go through auctions. So when a tenant doesn't pay, we actually have a lien on their property in our storage units. And if they don't pay within 30 to 45 days, we're legally allowed to auction off those materials to satisfy our prepaid, our back to rent. Usually when that happens, the buyer of the auction will actually come and clean out the unit for us, or else he loses his security deposit. And literally the same day we have a new tenant moving in. So the turnover is less than a day, and there's basically no turnover cost. Actually, in some situations, we actually might turn a profit on the turns.
Mm-hmm.
The next thing is we really love, and this is now super relevant today, is the recession tolerance or recession resilience of self-storage.
Mm-hmm.
If you look over the last 2 recessions, self-storage has performed exceptionally well and much, much better than the main real estate asset classes that people go into, such as multifamily, single family, industrial, office. Now, because it has, very low risk, people usually assume, okay, that means that the returns must not be that high either. And actually what we find is the exact opposite. Over the last roughly 30 years, self-storage has returned over double of what residential multifamily has returned in that same amount of time. So not only do we have decreased risk, but we also have a higher profitability on top of higher profit margins. Another thing we really like is the leverage that's offered to us by the banks has been phenomenal. 3 of the last 4 deals we closed on were actually at 100% financing.
Wow.
And that wasn't hard money lenders. We were paying 5.2% interest on that, first year interest only. And those were 5-year balloons on a 25-year amortization. So you're never going to find a loan like that for a single family or a multifamily property. And the main reason why is when you look at the data coming from the banks, they've noticed that self-storage as an asset class has the lowest default rate across their entire portfolios. And I'm getting data directly from Wells Fargo and Intech Solutions. So these are major data providers in the banking space. Now, in the very rare chance that they actually do default. And so, for example, just as a rate, self-storage will actually default, or I'll do it the other way. So multifamily will actually default 40 times more than self-storage, 40 times more than self-storage. So banks love self-storage to balance out their portfolio. The second thing is, in the rare chance that there is a default, the loss that the bank or the lender experiences per default is also lower than all the other asset classes. Usually on the scale of about 4 to 5 times lower than what the losses that they'd experience in a multifamily or a single family property. So all those things really pushed us towards going into self-storage. And another reason was just the management component. Like you said, getting calls in the middle of the night because someone didn't know they couldn't flush a cotton towel down the drain. With self-storage, it's very hands-off. The amount of time you need to manage these facilities is if you're a solid operator, you should be able to manage one of these facilities with about 4 hours a week.
Wow.
Depending on the size of the facility and where it's located and what type of help you have, boots on the ground. You can't say that with single family or multifamily. In my residential portfolio, before we decided to start selling them all, we got up to about 50 or 60 units, and we were spending probably 60 hours a week managing those. And that wasn't even a large portfolio, right?
Wow.
So it's just one of those things where as soon as we saw this, we decided, let's go into the space. And then we saw as well, on the other hand, when we're looking to acquire these facilities, the market is very fragmented. So what I mean by that is, in the United States, there's roughly 52 to 60,000 self-storage facilities. 18% of that is owned by the major 6 REITs, right? Your Life Storages, your Extra Space, your U-Hauls. 9% of that is owned by the next 100 largest operators, which means that 73% of all self-storage facilities in the US are owned by mom and pop operators, or usually not very sophisticated investors,
Sure.
which allows us to enter into these properties at very high cap rates. Our portfolio average for a day one acquisition cap rate is at a 9.7%.
Mm-hmm.
And that's before we do our value add. Once we value add, then we're usually experiencing 12 to 16% internal.
Excellent. So I want to touch on 2 things. One is the financing that you're able to get. Are those typically community banks, larger banks, or investment type banks?
Yeah, so these are usually local banks and community banks. What we've been focusing on is finding those local banks and those community banks that are willing to lend nationwide once they establish a relationship with us. So, for example, the last 4 deals that we bought, which were in Tennessee, North Carolina, Alabama, and Iowa, all of those were lent on by a local Iowa community bank.
Oh, nice.
Very cool. Yeah.
Because, that's tough to do, because a lot of them don't like lending out of their state,
Right.
if that's where all their branches happen to be. So
Right.
kudos to getting them into thinking outside of the box. But
Mhm.
that's a lot easier to do with a community bank than it is with your bigger banks. They're stuck in their box. They're stuck in their wet paper bags, actually.
Yeah. And that's what we notice, because we'll still talk to those guys, the Chases and the Bank of America. But the problem is they will try to just lump self-storage in with all the other commercial assets that they lend on. So they're requiring 30% down, 35% down. Whereas when you show these local banks the data provided by the big guys like Wells Fargo, and you say, listen, like, this is the safest loan you can make. And usually when you look at a bank's books, they're heavily skewed into the more risky loans, like providing 5% down FHA loans to homeowners, or fix and flip loans at 125% loan to cost, to rehabbers. Look at what's happening with those guys right now, right? I mean, There's a lot of deals that are sitting on the market right now, and they're paying the juice to the banks, and the banks are trying to figure out, the banks are not in the business of owning properties. They don't want to own properties.
Yep.
That's why when you show them these numbers, the banks usually come around and say, okay, you're right. This is going to balance out our portfolio. This is something that we can.
Yeah, that's awesome. I'm going to have Jonathan's going to ask you a question about the management side of things with all the automation in just a second. But we have
a couple questions here.
Yeah. So Donovan is asking, Are you building from the ground up, or are you acquiring the established units? It sounds to me like you're focusing more on the mom and pops that are established.
Yeah, so we do a little bit of both, but because we are primarily focused on cash flow, we kind of have a 10-to-1 ratio. So we'll do 10 cash flowing assets for every one ground up development we do, because usually for it to make sense to do a ground up development, we're going to do a Class A REIT grade facility that we can sell to a public storage or a life storage. So for example, on my existing cash flowing properties, we're usually buying those at anywhere between $1 to $5 million a pop. The ground up developments, the lowest one that we've looked at and have started working on was a $12 million project. We have a few more in our pipeline that are in the $15 to $20 million range. So I don't want to skew a lot of risk towards the development side unless I have the cash flow coming in from existing facilities to support the debt service.
Right. That makes sense. So you're basically at 10-to-1 on your percentage.
Yeah, 8-to-1, 10-to-1. It usually depends on the size.
Yeah.
All right, cool. And I know Sohail wants to connect with you.
And then he also has
we'll make sure we get out all your contact information.
And then Sohail wants to know what's your percentage on buying existing self storage, and I assume you mean that
was the 8-to-1.
Oh, okay, yeah.
So do you want to talk about how to manage these properties with all the automation and stuff?
I know, that's so. My question is, you have all of these facilities going on nationwide. How do you keep track of everything? How do you manage all these assets, know what's going on, keep that data coming to you so that the one in Tennessee is outperforming the one in North Carolina or whatever the deal is? Kind of walk us through how do you do that?
Yeah, so it first starts with the property management software. You want to make sure that you have a really robust system and that the software itself can provide some automation. So we use a product called Storage. It's owned by SiteLink, which is one of the large conglomerates in the space. They also own kind of the aggregators in the space as well, called Sparefoot. That software not only allows us to have online portals where tenants can rent and buy insurance, but they can also do it from their phone. They can sign leases from their phone, because nowadays this is what everybody uses, right? This is how they find you. This is how they communicate with you. This is how they pay for stuff. So that takes a lot of it, a lot of the management off of what, usually when we find an existing facility that we're going to do a value add on, we'll walk into these facilities and the managers basically using pad and pen to keep track of everything, or maybe some really old DOS based management system on a super old computer. So that alone will increase our efficiencies and allow us to increase our net operating income. Outside of the management software, then you can start looking at physical value adds you can do to add automation. So one of the things that we always love to put in is an automated entry and exit to the facility. So usually it's a little keypad that you drive up to. You put in your specific number that you're assigned, so we know when you're leaving and coming to the facility, so we can track you. And then you also need that keypad to exit, so we can timestamp how long you're at the facility. On top of that, you can put in kiosks. So they kind of look like little ATM machines. They're usually outside of the gated area. Someone can come in and they can, as long as they have an ID and a valid form of payment, it can either be cash, credit, or check. That machine will take it. You could rent your units from there. You can look and preview, certain sizes of units, and then it'll also allow us to sell auxiliary services like tenant insurance and locks and what have you.
Wow.
Interesting. So so you have certain number of units that are unlocked for display purposes only, or is there like a automated lock on there that just opens when that person gets to it, or when you're viewing it?
Yeah, it depends on the facility. So let's start on the, there's a spectrum. So on the super, let's say not tech savvy facilities, usually what it is just have a couple units that are unlocked for people just to go in and check them out. And then usually we can either leave a lock in the back of that unit or a application for somebody to fill out. So that's super non-sophisticated, right?
Right.
Then we go all the way up to the sophisticated side, where you have each one of the locks on each one of the doors are hooked up to the wireless system, the Wi-Fi, and they will unlock based on who's coming in and based on the inputs that are coming into that kiosk.
Nice.
Mhm.
Nice.
Some nice storage facilities.
And I'm thinking eventually you're going to be able to take that phone, use your app for your management company, and then just hold it up to the screen, and it will unlock the gate for you without having to punch in a key code.
Yeah.
Right?
So that's already here. It's Janus and a few other companies have something called a no key system, where you can unlock not only the doors leading up to the unit, but the front gate as well. And then also your actual physical unit itself is motorized, and you can open it just by clicking on your phone.
Nice.
Yeah.
So are there some value added services that you're not able to provide if you're totally automated, like, renting U-Hauls or, Penske trucks and that kind of thing?
Yeah. So what we found is that the truck rental it's a lot of work, and it causes your employee cost to go up kind of substantially. So, because self-storage facilities have such low break-even occupancies, the two largest expenses are usually going to be property taxes and payroll. Right. So we always try on the front end to decrease those, both of those costs as fast as possible. So the payroll aspect, you hit the nail right on the head. We usually will, if there's any U-Haul or truck rental existing on the facility, we're just going to get rid of that, especially because the liability it brings, and you don't know, did somebody damage the truck? Can you prove that they damaged it? Am I going to have to pick up that bill? So we don't usually like to do the truck rentals, but there's a ton of different services that can be offered without having to increase your payroll costs. And that could be, car storage, RV and boat storage, selling locks, renter's insurance, moving supplies, packaging materials, FedEx pickup and drop off, printing services, cell towers, billboard advertisements, wine storage, private mailboxes, all these things you can add without really increasing your manpower cost too much.
Nice.
Mm-hmm.
Cool.
I was thinking about if somebody does move out and they don't clean up, I mean, do you have to have, do you typically keep some sort of a manager part-time or whatever that can get out there and, or is that more of somebody like a facility maintenance person that would just be available to you, some sort of a service that's not really tied to yours, but is, subcontracted?
Yeah, exactly. So to keep the cost down, especially on these smaller facilities that are already stabilized, meaning they're at 90% plus occupancy, you don't really need a full-time manager, and you can get by with what we call boots on the ground, or like you said, it could be a maintenance person or a subcontractor that, they get paid maybe $250 to $500 a month just to go clean the facility, check locks, overlock people that are not paying, take off overlocks from people that have, got caught up on their back due balance, and then also put auction tags on facilities, on units. Mm-hmm.
Excellent.
Yeah.
Well, I know you have a pretty sophisticated way of finding properties.
Mm-hmm.
Yeah.
And you probably find some that are pretty good deals, but you have enough going on. Are you wholesaling any of this stuff?
Yeah. So actually later today, I'm jumping on a self-storage mastermind with a mutual friend of ours, Scott Myers, and I'm actually going to be wholesaling 6 properties today. So we're looking at probably 5 to 10 new opportunities a week. And a lot of them we're getting under contract at really good prices. Like I said, we're walking in at 8 to 11% cap rates day one. But it's getting to the point now in our business where we're growing so fast that the smaller facilities are not really of interest to us any longer. So anything, in the 40 to 50,000 square feet and below, we prefer to wholesale those to other investors, and then which allows us to focus on large portfolios, self-storage income funds, ground up developments, 1,000+ unit facilities. That's the stuff that we're really trying to go after now.
And so those 30 to 40,000 square foot facilities, what are the general price points for those?
Yeah, they're going to be anywhere in the $1 to $3, maybe $4 million, depending on what part of the country you're in. In the Midwest, the values are a lot cheaper. In the East Coast and West Coast, you're going to be paying a premium for these types of facilities.
Mm-hmm.
Excellent.
Well, when you first started and you were picking these up, how did you? What was your due diligence process? How did you identify? I know you said like 73% of these are owned by mom and pops.
Right.
How did you target them? Were you sending out letters? How were you identifying them and finding these deals?
Yeah. So what we started with originally, because we came from the wholesaler background, what we're really good at is sending out direct mail and talking to sellers, right? So we went to one of our data analysts, and I can connect any of the viewers on here with him. And we said, hey, here's what we're looking for. We're looking for mom and pop facilities in these 24 states. I want you to scrub out the top 100 operators. And I gave him a list of those operators. And then I said, I also want you to scrub out the top 50 management companies, third-party management companies, because usually those companies are also acquiring themselves. Mm-hmm. And they'll have some type of first right of refusal on their contract. So after he took that out, we were left with about, I think in our first campaign was about 7,000 self-storage facilities. And then we just started sending them letters. Hey, my name's Fernando. I buy self-storage facilities. Here's 2 that I just bought in the last 60 days. Give me a call if you'd be interested in selling. We can do it with no commissions, no fees, that type of stuff. And people just start calling in. And then when they call in, it's all about, building rapport. Self-storage is a lot slower on the acquisition side than, say, a single family home. Sure. So, we can be just building rapport with the seller for maybe a month, 3 to 4 weeks before we even start getting into the nitty gritty of pricing and, what the income's producing and proof behind the P&Ls and the tax returns. And it's just, for a lot of guys, their self-storage facility is kind of like their baby. So They want to know that, you're a good guy before you allow you to take it to the dance, if you will. And some of these owners, the ones that we really like buying, they've owned the facility for 10, 15, 20, 25 years.
Yeah. It's their baby.
Mm-hmm.
It's their baby. So when it comes to the underwriting of these things, after we find them, we're looking at a few major things right on the head. That's going to be, what is the supply in the area? Is it an oversupplied area? Is it an undersupplied area? We usually like to go into the undersupplied areas for obvious reasons. We will look at what the competitors are at. What are they charging? Are we well below market rents, which is usually the case when we walk into these mom and pop facilities, just because they don't have anybody on staff to be running competitor data on a daily basis, right? We will look at the traffic count on the curb cuts, because self-storage, even though right now about 60% of all of our clients come from us using a phone, they'll usually find us on Google. You still have a solid 40% plus of people that they'll drive past your facility every day and they won't even recognize it for 5 years. And then all of a sudden, when the day comes that they need self-storage, you're front and center because they drive past it every day to work, right? Yep. So they'll stop in and then they'll rent. Another thing that we really like to look at is, what are the value add opportunities as far as expansion go? Can we put up additional units? For example, the one I purchased in Franklin, North Carolina, we're tripling the size of that facility. We were able to buy not only the existing facility, but then it also came with an additional 4 acres of land right down the road.
Nice.
So,
wow.
Yeah, so we're going to be building on that one as well. And then once all of those things check out, then we actually will start diving into the actual financials of the facility. It's usually the last thing that we'll look at before making an offer.
Gotcha. Now, before now, because you obviously have relationships with banks where they can give you 100% financing. Yeah. When you're first getting started, how did you finance these deals? Like, for someone who's maybe trying to get into it now, what are some creative ways to finance these?
Yeah. So in the beginning, what I recommend people that, ask me for advice, I recommend that they start small and they start with something that they can drive to within 2 to 3 hours, right? Something that's somewhat nearby. My first facility was a $950,000 facility. It was about 2-hour drive from where I live. But that's even already on the upper end of your starter facility. We just wholesaled one for $125,000 to an investor. You can get into a facility for less than a house, right? And you can usually assume if it's going to be your first loan, the bank will require 20 to 30% down, which is typical as in a commercial loan. As you start to show that you have experience and you can show your track record and your profit and losses over time, then the banks will start getting much, much more comfortable, especially with the way that these appraisals are working. So here's an example of another one. Not too far from Franklin, North Carolina, we bought a property in Hampton, Tennessee, just over the border. And that property we purchased for $725,000, but the appraisal that the bank ordered came back at $1.2 million. So we went to the bank and we're basically like, you're crazy if you think I'm putting any money down on this property. You have all your protective equity right there. If you don't want this deal, no worries. I have 6 other banks that are willing to take this deal. Right? And you make the banks play against each other. So that deal, we actually had a cash out purchase. The property, it was $725 was the purchase price. It needed about $65,000 in rehab, and our loan was written for $825. So we actually walked away from closing with a $96,000 check, $65,000 of which we put into rehab, and then the remainder we just put in our pocket.
Sounds like the commercial version of a VA loan.
Yeah.
That's pretty funny.
That's pretty awesome.
Listen, I want to go ahead and get your contact information out there for folks and you do have a fund for accredited investors as well. So if you don't have $900,000 to buy a facility with, you have 100 and you're an accredited investor, you could do it passively, right?
Correct.
What's a good contact info for you for people to follow you?
Yeah. So easiest thing is to check us out on our website, thestoragestud.com. You can also, at me at any of the social media outlets at The Storage Stud. That's Facebook, LinkedIn, Twitter, Instagram, all over there. You can also check out our investor-based website, which is titanwealthgroup.com.
Excellent. I like the
storage stud.
That's pretty unique. You've been gracious enough with your time today, and you're being gracious to join us in the 1 o'clock hour where we're having a panel discussion. And I don't know if you know this or not, but Scott Myers is one of the panelists.
Oh, great.
So listen, I appreciate you coming on. If you'll join us here in about 10 minutes or so for the next round, that'd be awesome.
Absolutely.
Folks, thank you so much for joining us. Again, you can find out information about borrowing money in the Southeast for fix and flip and buy and hold temporary, because we're still doing fix and flip pricing.
That's right.
So if you need a bridge loan and you're in the Southeast, CarolinaHardMoney.com. If you're looking to invest in our fund, again, CarolinaHardMoney.com. Just click on the investor tab. If you're a borrower, click on the borrower tab. Don't forget to subscribe and share and like and all that good stuff as well. Fernando, thank you so much for joining us.
Thank you.
Thanks for having me,
We'll see you in a few minutes.
Yeah, talk to you soon.